$7.1 billion, blocked overnight. One signature in Canberra just rewrote the rules of who gets to own Australia's ground. Here's what this means for you. Critical minerals sit underneath nearly every piece of modern technology you touch: the battery in your phone, the wiring in your car, the components inside the data centers running the apps you use every day. When a government as resource-rich as Australia decides a foreign buyer cannot own a piece of that supply chain, the price and availability of those materials shift for everyone downstream, including you. This channel runs on no corporate funding, no government backing, and no advertising pressure telling us what to leave out. If you want to understand every move in the global resource war before mainstream media catches up, subscribe now, because this decision is bigger than one mining deal. It's a signal about where the entire critical minerals industry is heading. Let's start with what happened. Australia's government formally blocked a $7.1 billion acquisition bid targeting a major domestic mining operation, citing national interest concerns under its Foreign Investment Review framework. The official statement was carefully worded, language about national interest, about critical infrastructure protection, about ensuring Australian resources serve Australian and allied interests. Notice what's missing from that statement: any direct naming of the actual strategic calculation driving the decision. The official narrative says this is a routine regulatory review process working as intended. The operational reality shows a government making an explicitly geopolitical choice dressed in regulatory language. Foreign investment review boards exist in nearly every developed economy, and the overwhelming majority of applications sail through without incident. When a deal of this size gets blocked outright rather than approved with conditions, that's not bureaucracy functioning normally. That's a deliberate strategic decision, made at the highest levels of government, that someone decided was too sensitive to leave to default processes. Now let's go technical, because the mineral in question matters enormously here. Critical minerals, lithium, cobalt, rare earth elements, nickel, are not interchangeable commodities like oil or wheat. Each has a specific supply chain choke point, and in the current global market, a small number of countries control a disproportionate share of processing capacity, even when raw extraction happens elsewhere. China alone processes a majority share of several rare earth categories globally, even when the raw ore is mined in Australia, Africa, or South America. That processing bottleneck is the single most important fact in modern resource geopolitics, and it's exactly why ownership of mining assets, not just extraction rights, but the corporate entities controlling them, has become a national security issue rather than a purely commercial one. Here's what they're not telling you. When a foreign entity acquires a controlling stake in a mining operation, it doesn't just buy rocks in the ground. It buys influence over output decisions, how much gets extracted, where it gets shipped, which buyers get priority access during supply shortages. A government blocking this kind of deal isn't protecting dirt. It's protecting decision-making authority over an asset that becomes more strategically valuable every year as the global economy electrifies. Let me show you why this isn't just about one deal. This is a structural shift in how resource-rich nations think about foreign capital, and it doesn't go away once this particular transaction gets shelved. Over the past several years, multiple Western governments, Canada, the United States, several European nations, have tightened foreign investment screening specifically around critical minerals, battery materials, and semiconductor-adjacent industries. Australia blocking this deal isn't an isolated event. It's the latest entry in a pattern among allied nations to keep strategic resource ownership within trusted hands. Now here's the number that explains this entire situation better than any press release. Global demand for several key battery and magnet minerals is projected to multiply several times over within the next 2 decades as electric vehicle adoption, renewable energy infrastructure, and defense applications all compete for the same limited mineral base. Analysts tracking the sector describe looming supply gaps that could leave manufacturers scrambling for material years before mining output can realistically catch up. In a market defined by scarcity ahead, controlling who owns extraction rights today determines who is guaranteed access tomorrow. That's the real stake behind a $7.1 billion block transaction. The math here is brutal once you compare cost structures. Building a new mine from exploration to full production typically takes a decade or more and costs billions of dollars in upfront capital, with enormous geological and regulatory risk along the way. Acquiring an existing, already producing operation skips most of that risk and most of that timeline entirely. That's exactly why foreign buyers, including state-linked entities, have aggressively pursued acquisition of producing assets rather than greenfield development. It's faster, cheaper, and far less risky than building new capacity from scratch. Blocking acquisitions doesn't stop demand for the minerals. It just forces would-be buyers back into the much slower, much more expensive path of building their own extraction capacity or seeking it in jurisdictions with looser ownership rules. Stay with me because this next part connects directly to the global power structure. China's dominance in critical mineral processing didn't happen by accident. It was the result of a multi-decade industrial strategy that prioritized building refining and processing capacity, even when the economics looked unattractive in the short term, betting correctly that long-term control over choke points would pay off as global electrification accelerated. Western nations are now playing catch-up, and blocking deals like this one is a defensive maneuver in that catch-up game, an attempt to prevent further concentration of strategic mineral assets in hands aligned with a competing power block, even when the acquiring company itself is nominally private. China's reaction to decisions like this is calculated and patient. Beijing understands that every blocked acquisition in an allied nation strengthens the argument made consistently in Chinese state media and policy circles that Western markets are not actually open markets when it comes to strategic industries. They're open only when the outcome favors Western strategic interests. That argument resonates across parts of the developing world already skeptical of Western economic rhetoric, and Beijing uses it efficiently in diplomatic engagement with resource-rich nations elsewhere. Russia's interest in this story is more indirect but still real. Moscow has spent recent years deepening mineral and resource partnerships across parts of Africa and Central Asia, explicitly positioning itself as an alternative buyer and infrastructure partner for nations wary of Western ownership restrictions. Every time a Western-aligned nation tightens foreign investment rules around critical minerals, it marginally increases the appeal of alternative partnerships that come with fewer ownership conditions attached, even if those partnerships carry their own long-term strategic costs for the host nation. The Global South angle matters here too. Resource-rich developing nations are watching exactly how wealthy, stable democracies like Australia handle foreign investment in strategic sectors, because it shapes the playbook they themselves might use. If Australia can block a multi-billion-dollar deal on national interest grounds and face only modest diplomatic friction, that gives other resource-exporting nations more confidence to do the same when foreign buyers come calling for their own critical mineral assets. Shifting global negotiating leverage gradually away from buyers and toward resource owners. What this block deal really represents is the end of an era where capital could move freely across borders into any sector without political consequence, at least when it comes to the minerals underpinning the next industrial revolution. The defenders of that old open capital order will call this decision protectionist. The defenders of strategic resource sovereignty will call it overdue. Both sides have a case, and the resolution of that argument will shape mining investment patterns for the next decade. Let me pull back the curtain on how these review processes actually work behind closed doors, because the public rarely sees this part. Foreign investment review committees typically receive classified or semi-classified briefings from intelligence and defense agencies before making major determinations. That means decisions like this one are shaped, at least in part, by assessments the public will never see in full, assessments about ownership structures, ultimate beneficial owners, and connections to foreign state interests that go several layers deeper than the corporate entity making the actual bid. When a government blocks a deal in the national interest, it is often acting on information the public is asked to trust without verification. That's not a flaw unique to Australia. It's a structural feature of how every Western democracy currently handles strategic investment screening, and it raises legitimate questions about accountability even when the underlying decision is probably correct. Here's the dimension almost nobody is discussing: the precedent this sets for minority stakes and indirect ownership structures. Blocking an outright controlling acquisition is the easy case. Far harder and far more common in practice are deals structured as minority stakes, joint ventures, or layered holding companies designed specifically to stay under the threshold that triggers automatic review. Sophisticated buyers learn from high-profile blocks like this one and simply restructure future bids to avoid the same scrutiny. Expect the next major attempt at acquiring strategic Australian mineral assets to look very different on paper. even if the ultimate beneficial interest looks remarkably similar. Now consider the domestic political dimension, because this decision didn't happen in a vacuum. Resource nationalism plays well politically in resource-exporting democracies, particularly when paired with rhetoric about protecting jobs, sovereignty, and future generations' access to wealth generated by national resources. Whatever the underlying strategic calculation, there is also a straightforward political incentive for any government to be seen blocking a large foreign acquisition of a beloved national asset. Separating the genuine national security calculation from the political theater surrounding it is difficult and probably impossible to do with full confidence from the outside. Here's the bigger pattern this fits into. Mining and resource ownership disputes are becoming the new flashpoint in great power competition, replacing some of the attention previously concentrated on trade tariffs and technology export controls. Minerals are harder to substitute than manufactured goods, harder to stockpile at scale than energy commodities, and increasingly central to defense applications ranging from missile guidance systems to next-generation battery technology for military vehicles. Every block deal, every new screening rule, every renegotiated supply agreement is a small move in a much larger contest over who controls the inputs to 21st century power. Now let's talk about the company on the other side of this block deal, because the consequences for them are immediate and severe. A failed multi-billion-dollar acquisition doesn't just disappear quietly. It often triggers break fees, reputational damage with shareholders, and a scramble to find an alternative buyer or financing path for the asset that was supposed to be acquired. If the target company was relying on this capital injection for expansion or debt restructuring, the block deal can create real financial strain that ripples through to suppliers, contractors, and local communities dependent on continued investment. National security decisions, however justified, carry real economic costs that someone has to absorb, and it's rarely the government making the decision that absorbs them directly. There's also an alliance management dimension worth understanding. Decisions like this one don't happen without at least some coordination, formal or informal, with allied governments who share intelligence and strategic concerns about critical mineral supply chains. Australia rarely makes a move this significant in isolation from broader conversations happening among Five Eyes partners and other close allies about coordinated approaches to economic security. That coordination is part of why you're likely to see similar moves from allied governments in the coming months, responding to assets and acquisition attempts that haven't yet made headlines. Here are my 3 predictions with a clock attached. First, within 6 months, expect at least one additional major critical minerals acquisition attempt by a foreign buyer to face increased regulatory scrutiny in Australia, Canada, or another allied resource exporting nation. As this decision sets a precedent, regulators feel emboldened to follow. Second, within 18 months, watch for accelerated investment from domestic and allied nation capital sources, specifically targeting the blocked asset or similar ones, as governments actively work to keep strategic minerals in trusted hands rather than simply blocking foreign bids without an alternative plan. Third, within 3 years, expect this kind of foreign investment blocking to become standard practice across the critical minerals sector globally, fundamentally changing how mining mergers and acquisitions get structured from the outset, with buyers increasingly pre-screening political viability before even making an offer. Drop your prediction in the comments. Does this block deal mark the start of a broader wave of resource nationalism, or is it a one-off decision specific to this transaction? Tell me, because I read every single one. If this gave you a framework for understanding the resource war happening beneath the surface of ordinary business headlines, share it with one person who needs to see what's actually driving these decisions. The next video goes somewhere even this one didn't reach. Subscribe, so you're there when it lands. That contest will not resolve cleanly, and it will not resolve quickly. But every decision like this one moves the pieces a little further, and the players paying closest attention are not the headline writers. They're the resource ministries, sovereign wealth funds, and defense planning offices in Beijing, Washington, Brussels, and Canberra, all quietly recalculating their next move based on exactly what just happened in this one block transaction. Let's go back and examine the buyer's profile for a moment, because understanding why a specific bidder triggers a block rather than approval tells you almost everything about how these decisions actually get made. Foreign investment regulators distinguish, at least informally, between purely financial buyers, pension funds, private equity firms with diversified investor bases, and buyers with ties, however indirect, to state interests or industries considered dual use. A bid from an entity with layered ownership, eventually tracing back to a sovereign wealth fund or state-linked conglomerate from a strategic competitor nation faces an entirely different level of scrutiny than an equivalent bid from a pension fund with no such ties, even if the headline, purchase price, and stated business plan look identical on paper. This is the quiet sorting mechanism behind nearly every block deal of this size, and it rarely gets explained clearly in public statements because doing so risks diplomatic friction. Here's the historical pattern worth understanding, because this is not the first time a resource-rich democracy has had to make this exact calculation. Canada faced a strikingly similar set of decisions around rare earth and lithium assets in recent years, eventually unwinding certain foreign investments after intelligence assessments flagged long-term strategic risk. The United States has used its own foreign investment review mechanism with increasing frequency on mining and battery materials transactions specifically because of supply chain vulnerabilities exposed during recent global disruptions. Each of these cases follows the same underlying logic. Democracies that spent decades treating capital flows as politically neutral are now treating certain categories of capital as inherently strategic, regardless of the legal structure wrapped around it. Now consider what this means for the ordinary mining executive trying to raise capital for legitimate expansion. Every block deal makes financing marginally harder for the entire sector because lenders and investors now have to factor in political approval risk alongside the usual geological, commodity price, and operational risks already baked into mining finance. A project that looks bankable on every conventional metric can still die at the regulatory stage if the wrong capital source shows up at the wrong moment in a politically sensitive environment. That uncertainty itself becomes a cost, even for transactions that have nothing to do with foreign state interests, because the bar for what counts as acceptable capital keeps shifting. Think about the second-order effect on exploration spending as well. Junior mining companies, the small, high-risk firms that do much of the world's early-stage mineral exploration, depend heavily on whatever capital is willing to take on exploration risk, regardless of its national origin. If certain categories of foreign capital become politically toxic, exploration funding can dry up precisely in the early stages, where it's needed most, before a deposit is proven enough to attract domestic institutional money. Blocking a single large acquisition doesn't just affect that one asset. It changes the calculus for capital allocation across an entire exploration ecosystem that operates on thin margins and long time horizons. There's also a quieter diplomatic story unfolding behind this decision. Allied governments coordinate, formally and informally, on which categories of critical mineral assets deserve the highest level of protection from foreign acquisition. Expect ongoing dialogue among trusted partner nations about creating shared frameworks, potentially even shared funding mechanisms, to keep strategically vital mining assets within an allied capital pool, rather than leaving each nation to fend off acquisition attempts individually. That kind of coordinated capital alliance, if it materializes at scale, would represent one of the more significant shifts in how Western economies manage strategic resource ownership in a generation. One last layer before we move to predictions. Watch the commodity price reaction in the days and weeks following a decision like this, because markets often reveal what officials won't say directly. If the targeted company's share price falls sharply on the news, it tells you the market believes the foreign capital was genuinely needed, and no easy domestic replacement exists. If the price holds steady or even rises, it suggests investors expect a domestic or allied buyer to step in quickly at a similar or better valuation. That market reaction, more than any government statement, is often the clearest real-time signal of how seriously the broader investment community takes the national security rationale behind the block. It's also worth noting how rare full, unconditional blocks actually are compared to the much more common practice of approving deals with heavy conditions attached, divestment requirements, board composition rules, data access restrictions, or phased ownership caps. A government reaching for an outright block rather than a conditional approval is making a statement that no set of conditions could adequately address the underlying risk. That's a meaningfully stronger signal than most coverage of these stories tends to convey, and it's exactly the kind of nuance that gets lost when a headline simply says a deal was blocked without explaining the spectrum of regulatory tools that were available but not used.